Welcome to RBC's Markets in Motion podcast, recorded April 6th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Keeping up with the news flow since the Road Garden tariff announcements last Wednesday has been an exercise in futility for this podcast, but not our written research. In today's edition of the podcast, we wanted to highlight some of the more important things we've written about over the past few days to make sure our podcast listeners don't miss them. The big things you need to know. First, on Friday morning, we cut our S&P 500 EPS forecast for 2025 to $258 and our year-end 2025 price target to $55.50. Second, as the stock market has continued to gap down, we've continued to highlight our tiers of fear framework for how far U.S. equities could fall in different scenarios. Third, our weekly valuation and flow updates provided us with some insight into why U.S. equity markets have gapped down so severely. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. We'll start with takeaway number one. We cut our S&P 500 EPS forecast to $258 and also cut our year-end 2025 S&P 500 price target to $55.50. This is the second time we've cut both forecasts this year. Back on March 17th, we lowered our EPS number to $264 from $271, and our price target went to $6,200 from $6,600. Our new EPS forecast of $258 bakes in real annual GDP growth of 0.5% this year, inflation in the upper threes, a few Fed cuts, and margin contraction. These are all worse assumptions than our prior forecast, which baked in 1.6% GDP, inflation in the upper twos, no cuts, and flat margins. It's a stagflationary set of assumptions, but not a recession scenario. Our price target, as always, is close to the average output of 5 different quantitative models. Our sentiment model says our new target, and most of our other models are being too pessimistic. It reminds us that stocks tend to go up more than 10% on average on a 9-month forward basis after net bullishness on the AAII Investor Survey falls to levels more than 2 standard deviations below the long-term average, which is where it's been since late February, essentially down around the GFC and 2022 lows. Most of our other price target models are much more downbeat. On the policy side, we're no longer baking in business-friendly vibes or the typical market return when Republicans control the White House, Senate, and House. Now we're baking in the 6% annual decline of 2018, when the stock market also grappled with frothy sentiment and positioning to start the year, Trump's first trade war, and policy error, which back then was from the Fed. That suggests the index ends the year at 55.15. Meanwhile, our GDP test bakes in the typical decline when GDP ends up in the 0 to 1% range, which is a drop of 17%. That model suggests the index ends the year at 48.76. Meanwhile, our valuation model, which bakes in the same macro assumptions as our earnings model to project a trailing PE at the end of this year, points to a PE of 20.7 times or 53.51 on the index at the end of the year when used alongside our EPS forecast. As always, we view our price target as a compass, not a GPS, and as a signaling mechanism for the path we see the stock market on. We think enough damage has been done to knock the market off its constructive path. We do plan to keep revising our models if and when new information comes to light. Let's move to takeaway number 2. Our tiers of fear is a good thing to keep handy as stocks gap down. Our price target change on Friday was a well-telegraphed move. Throughout March, we'd been telling investors that the risk we'd have to pivot away from our base case, originally 6,600, then 6,200, and over to our bear case, which we originally set at 5,700 back on November and then revised down to 5,550 on March 17th, was growing. We indicated that for our base case to pan out, the drawdown since the February peak needed to be contained at 10%, and that if we broke significantly below that, our bear case, that 5550, was a more reasonable way to think about where the S&P could end up at the end of this year. Unfortunately, on Thursday, we broke through that 10% threshold decisively, triggering our decision to downgrade our view of where the S&P would end the year. So what was so important about that 10%? Our tiers of fear framework maps out what drawdowns have looked like in the U.S. equity market in recent decades. Tier 1 is a garden variety pullback, or a drop of 5 to 10%, that held before the Rose Garden ceremony and fell apart immediately after. Tier 2 is where we were when markets closed on Friday. At that point, the S&P was down more than 17% from peak, right in line with the average drawdown of 2010, 2011, 2015-16, and 2018. Those were all growth scares in which markets priced in big systemic issues or a recession that didn't end up materializing. These were the U.S. debt downgrade, the European debt crisis, the industrial recession, and that first trade war in 2018 that we already talked about. Those all ranged from 14 to 20%. A 20% drop this time around takes us to around 4,900 on the S&P 500, a little bit below, I believe. And interestingly, our technical strategist also told me on Friday that he sees important support for the S&P 500 at 49.54 and 48.84. What if we break those levels? Look to Tier 3, a recession. There, the median and average drawdowns have been 27 and 32%, which would take the S&P into the 4,200 to 4,500 range. We see the risks of this scenario growing, but it's not our base case right now. Tier 4 is a major crisis, like the tech bubble or GFC. There aren't a lot of those in our sample. The S&P fell 49% during the tech bubble and 57% during the GFC. If you keep it simple and say 50%, that takes us to 3,100 on the S&P. We'll wrap up with takeaway number 3, a few clues from our valuation and flows analysis. We were tempted to skip our weekly updates on Friday, but we're glad we went ahead and did them as we learned a few helpful and interesting things. First, on valuations. If we pretend for a minute that earnings forecasts don't need to come down a lot, which we absolutely know isn't true, the S&P 500 still doesn't look cheap. The various gauges of forward PE multiples we've been tracking are still well above average. NASDAQ 100 PEs, though, have gotten close to average. Small caps have made a lot more progress, with the Russell 2000's forward PE well below average and getting close to recession lows. The index ended Thursday at 13.5 times and usually bottoms in a recession between 11 and 13, even before the excess earnings optimism is corrected. And finally, on flows, the weekly EPFR data, which actually didn't capture Thursday or Friday inputs, has nevertheless now highlighted 2 consecutive weekly outflows for U.S. equities, with weakness now seen in large caps and large cap passive in particular. Meanwhile, the inflows we'd been seeing to Europe and Germany have been decelerating. A few weeks ago, U.S. equities were under pressure due to geographical rotation. Even before the Rose Garden announcement, though, there were signs that outright de-risking had begun. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.